All right, Ira Harris is joining us today, day before tomorrow's Fed meeting. Welcome, Ira. Thanks for returning.
Yep, pleasure. I think the message was to discuss the Fed meeting tomorrow. And of course, we had the BOJ the other night, which is, it is, well, so now we'll get three major bank meetings this week. BOJ was Sunday night, Monday. We have the Fed today, tomorrow, and then the ECB with a press conference on Thursday. So the three big guns of the liquidity heads around the globe. So interesting week. But I think at this juncture, we want to talk more about the Fed, of course. And there is no, I read all these prognostications, well, they're going to do this or do that, and they may do this, they have to do this. Probably the best takeaway is you're going to get the question is about, and it's going to be more about the question. What are they going to ask? They're going to ask the economic impact from the coronavirus. Okay, we know. How substantial? That we don't know. How high does unemployment go? We've heard from Fed officials themselves, and their guesses are all over the map. Does unemployment go over 20% in the short term? Maybe. It'll certainly be in the double. We'll be well into the double figures, as we can see from where we are with jobs. 26 million. And that's a good percentage of the workforce, and more to come because workers aren't being called back. It's not taking place that fast. And you can see, go through it. And of course, with economic modeling, especially when it comes to demand and unemployment effects, they all look at the multiplier effects. Well, multiplier effects work in positive ways and they work in negative ways. So once you lose 100 vendors at a baseball stadium and you lose all those salaries and everybody outside, you start to see, and you have to look at it like that, how many jobs are affected. And you know what? The numbers become big and they come fast. I was having this discussion because we all forget. What if there's no college football season? Let alone a pro season. What's that going to look at? And all the jobs that get associated with it. That's what you're losing, because everyone leads to another. The people who drive the equipment trucks from one city to another. All the airfares. I mean, I'm just giving you like a microcosm of how this works and why this has been so devastating, because you've had all that loss of incomes. And now you say, well, they've gotten checks. It's just not the same. And I know some people are out there going, well, people are getting paid more not to come to work. I saw about somebody who owned, what city was it in? Had a bunch of car washes, and you can't get the people back because they're making more money under the federal program than they are. So they're making $22 staying home, where he was paying them, he said, $15. So you know what? They're not ready to come back to work yet. So we don't know, and believe me, I don't get into that. Some of that is just such nonsense argument. I think people, for the most part, want to go to work because it's not only a way to earn money. It's, for a lot of people, it's a social thing as well. And the social may be every bit as much important as earning a living, and they miss that. But how it all works out, we don't know. Chicago, New York, some big cities are a lot worse. I'm here in Arizona. I can already see that. I was at the supermarket yesterday, and it was interesting to see how many people already got rid of the masks. Because you just sense, you see the look on their face. I had a mask on. Yes, they maintained the 6 feet. That was pretty good, but I see very early. So but when does this reverberate back into the economy? You know, and that's going to be the predominant issue that Powell is going to be confronted with. You know, and for all the programs they have put in place, we really don't know how much has been actually put into action, because there are those who are out there saying that yes, the Fed announced, what was it, 4 weeks ago, about that they'd be purchasing the ETFs of high yield instruments, but there are people out there who say they haven't bought anything, they haven't had to. That, you know, and we know, I think we were on that day or the next day, and you saw the jump in those ETFs, and it was very significant. So did they accomplish a lot, almost like Draghi in 2012, when whatever it takes, and it was never a dime allocated to the outright monetary transactions, the OMT program, because the conditions were too severe. And has the Fed actually not done anything? Because, you know, the Fed is a little bit in trouble with this announcement on the high yield stuff under, well, we've talked about that, written about 13.3 of the Federal Reserve Act. And
hey, how you doing? Can I call you back in a little bit?
I'm sorry?
Take care.
Oh, so, you know, the Fed they're being a little cautious here and coy, because they're running afoul of certain, some congressional people, so they have to be careful. So all of that said and done, what is Powell going to tell us? He doesn't know when this is going to end. They'll be watching carefully. So some people are talking about that they want to see forward guidance, in that they want to see that the Fed openly says that they will be far easier and longer, because they'll err on the side of that. They don't want to remove this. So if I was sitting in that room asking questions at the press conference, everything I would talk about is, do you have an exit strategy? Any sense of an exit? Okay, you may not be able to time when this ends, but how aggressive will you be in removing all the liquidity provided? That's what I'd want to hammer on, nothing else to me, because this is where the Fed continually gets into trouble. They overstayed for so many years, and again, you know, I go back to the first thing with Bernanke, when he cowered in the face of a market reaction, both bond and equities, when he announced a taper tantrum. And then when he backtracked immediately, the markets knew they owned the Fed. And again, I can go back to my 2013 May and June blogs when I talked about that. It was a huge mistake. You can't let the markets control you. The Fed has to be the one who says, you know, as McChesney Martin famously said, we're removing the punch bowl just when the party's really starting to get started. Well, the Fed, since really Greenspan, with the Greenspan foot, but certainly under Bernanke and Yellen, they didn't go that route. I think they didn't go that route. Yellen, I think, wanted to, but they cowered. And then, of course, we saw the greatest cowering was, and very openly, from December 2018 to January 19th, with the Powell pivot, and how dramatic that got. So the markets feel that it's not the Fed dictating to them, it's them dictating to the markets, because they seem to absolutely set their policy based on what the financial markets do. And honestly, in my opinion, that's what's gotten them into trouble. And that's what I would be hammering on. And I would push Powell on it. Tell me your exit strategy. Give me a sense. What are you looking at? How will we know? And my criticism of the Fed is that they should have done this with 180-day sunsets. So, okay, we're going to do this massive liquidity. I mean, this is what we're going to provide. But after 180 days, we're going to take a look. And if the economy is bouncing back, we're telling you now, we're going to start removing. So the markets, there's no surprise. That's the type of forward guidance too. saying, hey, here's our exit. Don't be surprised at because this is coming. So it's incumbent upon the markets to be prepared for it, rather than the Fed always having to cut and run from an exit strategy. And that's what I'd be looking at this meeting. I don't know what else he can tell you, because they have no certainty. They don't know when a vaccine is coming. They don't know what the healthcare. Hell, you know what? For the most part, we still haven't even lifted any of the quarantine. Yes, you know, little bits here and there, but and the quarantine is what's so affecting the markets. You know, again, you know, I go back to the Wall Street crowd, who for the years talked about, for certainly the last 2-3 years, as the market was, you know, running to its new highs and especially after Powell did his pivot. Well, unemployment is at 3.5%. We're at record on, and the consumer is doing great, and jobs are plentiful, and you know what? You see how fast that turned. So, you know, I'm not buying that, because the consumer has not been that great. Now the consumer really needs a shot in the arm, but the consumer was carrying massive loads of debt. And again, that's the problem of where we're at. And that's what the Fed has come to realize. This economy was nowhere near as healthy as some people thought, because the debt loads just can't be sustained. And that is one of the great unknowns. I just got off the phone with my own bank person and we were discussing this, and I said, hey, you can't tell me how this comes in, because you're talking about high yield debt. I said, I wouldn't be buying after certain companies who I think are able to withstand this, but high yield debt, look at, there's a lot of stuff going on out there with hotels, airlines, commercial real estate, residential real estate, where there's a whole lot of debt. There's no income flow because people aren't paying. You know, when you have an announcement from Gap that they're not paying their rents, well, again, that's a multiplier effect too. Because if I'm leasing an apartment in the city of Chicago, and I see that all these big retailers have openly said we're not paying rent because we have no business, well, I'm kind of hard pressed to pay my rent too, because hell, if it's all going to wind up in litigation, let's litigate.
Well, what do you think's going to happen with with this whole mortgage thing at the end? Do you think they'll even address it at this meeting?
Well, that'll be interesting, yeah, because you know, everybody's talking about the 3 to 6 month forbearance, and what does that mean? And whose forbearance? Are the banks going to? You know, the banks have major loans outstanding in commercial real estate, and then you have those who own commercial real estate backed securities, and you have residential. So there's debt instruments piled on top of debt instruments. So when they throw these numbers around, they're massive, and that'll keep, of course, the Fed more cautious, because as we're talking about it, they don't know either. They don't know either. Everybody is learning here, and they're learning that, first of all, there wasn't enough savings. So if we go into the Lacey Hunt, who I have great respect for, as we've talked before, you know, Hunt thinks, so even though the Fed's creating all this liquidity, it's not doing anything because nobody's making loans. If you're a real estate person, are you going to the bank and getting a loan today? Highly doubtful. And the only people who the banks want to lend money to is, again, people who don't need money. And those are fewer and fewer between now, because even large corporations who have earning power went into this situation with very little cash on hand. You know, why? Because they were doing stock buybacks. And that's why people were looking for a V recovery. I just don't see it, because all these stock buybacks, and they'll end for quite a while. And the enhanced dividend programs, I don't think you're going to see them. People just are not. They're going to want to build their cash situations, which will also keep the Fed on hold, because if that in fact is going on, rebuilding balance sheets, or what Richard Koo wrote about in 2007, 8, and 9, and 10, what he called a balance sheet recession, which is households and businesses were busy repairing balance sheets. Well, this one is actually the balance sheet destruction is probably worse than it was, because that was in certain areas. This covers a whole broad gamut of businesses, from, and especially little businesses. Look at restaurants. And that's what I was going to say before. Restaurants, bars, all those types of things that were such great job engines. Well, that's gone. And not only are they not job engines, they've absolutely went into massive reverse. So there's still too much uncertainty. And the deflation school, which the Fed has to fear the most, as you know, I can't be more straightforward on that. That's what they fear the most. And the deflationary argument made by Hunt and some others is real, because if this money, all this liquidity has no velocity to it because it's not being lent and nobody's doing anything in creating businesses or going back, then we're not going anywhere, and the Fed will be cognizant of that. So then you can look, that's why they're demanding forward guidance. How long do you see this? Well, the Fed's forecasting machinery hasn't been that good, by the way. It's just like with the CBO coming out. I care not with the CBO. That just gives everybody political cover. I know that'll irritate some people. I have very little respect for the CBO and what their longer-term forecasts are about. The fact of the matter is, we don't know. And I think that's what you're going to hear over and over from Powell. We don't know. So we plan to stay lower for longer until we get some sense of how this unwinds. And I don't know what that is. Is it 6 months? And of course, then we're into an election. But I will say this, what will come back to me, the White House and Congress have wasted so much time. Now they're wasting money, but this is when they should have had that massive infrastructure program in place. And I'm wondering whether he'll get questions about that. Do you think that the United States could now take on a massive infrastructure program of $1 trillion or $2 trillion? Because that should have been in place now. And for all those that said, well, unemployment is just, too strong, where are you going to get the workers? Well, we certainly resolved that issue in a hurry, haven't we?
Well, all those people, you're so spot on with that, because people are going to need jobs, and they're not going back to their old jobs.
No, because we don't know how many of those businesses are still going to be in business. Let's be very forthright about that. We just don't know. We don't know. We don't know how many of these restaurants. And again, the damage done from those who haven't and openly and willingly talked about, hey, I'm not paying rent. Well, now who's going to carry you for the next round? There's going to be a lot of ill will. There's going to be a lot of ill will. And, look at you've got very prestigious department stores, Neiman Marcus, Nordstrom, the best of the best that weathered, we're not talking JCPenney and their problems. We're talking who may well be in bankruptcy and how that gets worked out, and that huge amount of commercial real estate that's available. You start really looking through this with a microscope and you go, wow, now I see, and let's look at where this damage is. It's significant. And now, how much real estate do I really need? If I'm a New York-based financial company and I've been doing all my work through Zoom or some other type of online, and you go, well, do I really need all that expensive real estate? It sure makes a company like AllianceBernstein, who decided to move their headquarters from Manhattan to
Nashville.
To Nashville, thank you. You're going to see more of that. Okay, if I need a presence, okay, here's my presence, because I can do a lot of this stuff. And so we are going to have a dynamic change in the way people think about it, because, I'm going to be cut. If I'm increasing my savings, and that goes for corporations as well as individuals, I'm going to be cutting my expenses because a lot of these savings are going to come out of expense cuts. So maybe I don't need all those people. So this is going to be with us longer. And I think that's, again, so the forward guidance discussion better be in that vein from Powell. But I think you're going to get a lot of, we don't know, but they'll be saying, oh, listen, we think we stemmed the worst of the crisis. We held the financial markets together. We brought stability. Okay. Yes, yes, yes. And the more you allow it, the Wall Street crowd loves it because, again, they're totally centered on equity markets. And they're not concerned about the down. They're concerned about the up and all the money that they have under management and how they manage it. And you know what? For them, this has been great. It's been a saving grace because it did. Because had they gone through another month of another 10% down, so that the market would have been in 2 months' time been down 40%. I think the financial industry would have been under a lot of strain and stress. I mean, they were anyway, but nothing like the continuation. And again, you have other businesses. I've read numerous articles about universities and how is this going to play out. And there's a lot of economic.
Their alma mater isn't going to open up in the fall.
Well, you know what? There are a lot of discussion, and who's coming? And well, what am I paying? $50,000 for an online, $70,000 for an online? No, that's not the experience. So, a whole lot of things going on. There's going to be a massive amount of fallout. Unless
to kind of support what you're saying, Ira, and you've been around a long time, and I've been around a little while, and this generation, maybe they have no clue of how deep unemployment recessions unfold. Like we've seen in the past, in the 70s and early 80s, and I was out at my glider club on Saturday, and these are guys who are a lot of good, well-paid guys out there. Well, 2 of them told me they're losing their jobs. And there's like a dozen guys out there. And I figure some of us aren't going to be hit. A bunch of us are retired. Basically, probably about a third of the guys out there who are on that field were losing their jobs. And these are guys who make a lot of money. And one guy said his job is over. It will not come back. This is just getting rolling. That's what I'm saying.
Yeah, no, that's right. And I'll reiterate again about the energy patch, because I talk to guys who are really smart. I'm not talking Wall Street guys. I'm talking about guys who are actually in the hands of, and they're talking about these high-priced jobs, and they're not coming. Will they come back? Maybe in time. It all depends how this plays out. When you're losing high-priced trucking jobs, drilling jobs, these are, you have people in the Bakken and the Dakotas. These are people living in North Dakota making $1.20, $1.50. Those are damn good jobs. And that's why the average hourly earnings I'm expecting to drop dramatically. That's where there's going to be a hit, and it'll tell you some of the precursor to some of the immediate deflationary impact. How this all plays out, we haven't seen that, but that's as we go forward. I think we have an unemployment number on Friday, don't we? Do we?
Yeah. Ira, here's a stat for you. But first, I just want to tell you, Peter and I were having a conversation about a Fed exit strategy. We were having this conversation last week about a Fed exit strategy. The best I can come up with is that they're just going to put on a pair of sunglasses and watch the paint dry. That's my initial thought about that. But going to unemployment, so back during the financial crisis of 2008, continuing claims, not initial claims, but continuing jobless claims, peaked out in the back half of 2009 at about 10%. And that was with continuing claims at 7 million. Okay, so 7 million equaled bank charge-offs at a 10% rate. This time around, we are now at almost 16 million as of last week. okay, I'm just rounding up a little bit. We're just about at 16 million for continuing claims, okay? And this isn't done yet, like you've been saying. So if you just want to extrapolate that out, you could say, hey, you know what? Bank charge-offs this time around could potentially end up somewhere around the 20% range, but definitely somewhere above the 10% from 08, 09, right? And so far, you look at JP Morgan. JP Morgan last week only reserved about 2.5%. Synchrony Financial, 55 freaking basis points on their loan book. And that's, so what I can tell so far is that the financials are way behind the curve as far as their reserves are concerned.
Good.
So, you know, so I just wanted to say 7 million equaled 10% back then, 16 million today. It's got to end up somewhere above 10%.
These are all really great points. And again, you're going to hear, and rightfully so, they don't, you know, so much now, even if you got a vaccine, okay, that's a question. If you got a vaccine by, and this is as positive as you can imagine, by August, okay? When does the economic impact really take place? You know, how do you get back to the college football season? And I'm only using this because, again, the multiplier effect, the number of jobs are enormous. Enormous. This is the service economy that we live in. You know, rock concerts, symphonies. You think about all the people who are massively affected, and they don't know when they're coming back. And who's going to carry this load? When you really start to dig down into it, it's amazing. Again, I know because my daughter's a chef, and she was over last night, and we were talking, you know, and yeah, they hear things, but, you know, how are you going to change your seating schedule? How many people are you going to be able to see? You know, it's enormous, the impact. And it's, I don't know, and the Fed doesn't know. And that's what we'll hear. And now that's about the vaccine. Now, let me tell you this, okay, so anybody else have any questions about the Fed?
Yeah, we got a couple of questions here. One, Jeff wants to know, you know, about 2Liquid with the Fed and how long, you know, now you've talked with, in your last FRA podcast about the deflationary side of things and when would you expect there might be normality and a risk of high inflation?
That is the question that people are going back and forth with. If all of a sudden you would start to see the velocity of money, this will be if the velocity numbers like the people that Lacey Hunt work with, and they're good, they're high quality, played out over time. If you started to see that and the Fed still remain reticent, let's say for another year, then you'll start to see the inflation. But I'm of the mindset, and it's actually a prescription from the Rogoff, Reinhardt book. This time it's different. Is that you know, they talked about, and this was coming out of 2008, 2009. I'm using their numbers. You know, Rogoff had put forth that what they needed was 5 to 6% inflation. You know, because don't forget, there's an asymmetric bias, because that's the legacy of Paul Volcker, is that central banks believe they can always crush inflation by raising rates. And that's proven, where they don't know how to get the economies going from a deflationary situation, which of course, you know, Japan is everybody's example, even though these things are never perfect. So, and they're not perfectly correlated either, by the way. So we don't know. It is the penultimate question going forward. But And again, that's why gold doesn't go up because of inflation. Gold goes up and this is my opinion, and I think it's been borne out over and over. It goes up because it knows how far central banks will go to stop deflation. When it comes to solving the inflation riddle, that's so far off because there's nothing more the central banks would like than to have inflation, because you want to get rid of debt. Inflation is still the greatest instrument on a historical basis from getting rid of that debt. So
It's a default by millimeters.
That's the way it plays out. So, and that's what they know, and that's what they're comfortable with. Let's be honest. Again, what we've learned again is that the Fed cares nothing about your savings. They don't care about it. They've just told you, because they were so quick to do what they did and to drive rates to zero, and they haven't cared about anybody's savings. And in fact, Yellen and Bernanke themselves stopped crying, when they were getting letters in hundreds, if not thousands, talking about how they're killing people with savings, and they told you, stop crying. Your grandchildren have jobs, your house has gone up in value, your stock portfolio, so stop crying. They care little about anybody with savings. They care not. They need to bail out, because we live in a debt-based society. Our entire system, and now it's global in nature, because don't forget, credit cards were first an American ubiquitous act. And I can remember when it really took place, because I was for front and center, and I fought having a credit card. But the whole society became based on having a credit card. You couldn't make a hotel reservation. You couldn't lease a car. Everything became with the credit card. And so we live on credit. And credit is to be wiped out through inflation. There's nothing worse. People have to wrap their head around this. The worst thing for a debt-based society is deflation. So when they talk about hitting that target, there's a reason. There's a reason. If they go above it, even better. And they may not say it openly, but the Rogoff prescription from This Time It's Different, the book that was the rage, when it came out, because of course, if you're at Harvard, when you're taking $9 million, whether you need it or not, you have panache and you have credibility, and their view is 5-6% inflation for a year or 2 or 3 years, and you know what? If you're paying it back with cheaper dollars, great. That eases the debt burden going forward, and that's what the game is. So how long will they stay? Don't know, and that's what we'll be waiting for. Everything else is just, to me, gibberish. They'll dig inside the plumbing and, what did you do this? And, are you doing that? There's numbers we'll never see, we'll never know. But we do know that the Treasury is coming to market with, hundreds of billions of T-bills in order to finance every program that they keep coming up with to put money in people's pockets. So
yeah, in the meantime, the 10-year's rallying. The gold miners, the silver miners are all taken off. And Michael's got a question here. He said, when oil ran out of storage and priced to be sold with cash, what happens to gold if they can't deliver due to supply chain interruptions?
Well, Michael, that's a very good question, and he knows the answer, because I know. What do you work for the New York Times now with these straw men? Sorry, Mike, I have to go after you a little bit. It's exact. And somebody just wrote about it yesterday, that it would be the opposite effect, of course, which is that there'll be no sellers. So gold could never bid for storage. That's not possible. Okay. Hell, you could store this, there's vaults all over the world. You can store this. You can build a vault. It's not like oil. And you're never taking that much out of the ground at any time. So that would never be a problem. There was an interesting article this morning, and I'll bet Michael saw it, about, hold on. Let me cite it, and then I'm going to close. I'll give you, there's a piece from Reuters, I think. Let's see. Yeah, Reuters. Shanghai gold boss wants super sovereign currency for post-crisis times. Got it?
Wow.
I'll send it. Okay.
Yeah.
I'll send it to Judd. Hold on.
All right. Now I'll post for everybody.
Wait. Yeah, I'm going to send it to you right now. So that's the other side of the coin, but that's really kind of what we're talking about, because you're in a situation now where nobody trusts each other in the world, and by design, because the central banks have created this situation where, again, they told you that, okay, you should have it right now. So they've told you point blank that they will destroy the value of your currency. End of story. They will do it. They don't care, because they need to prevent deflation. And you can accept that argument, you cannot accept that argument, but they're telling you that they will not allow it. And if that's the case, it makes it very difficult to think about your money and what you do with your money. And that's what Michael's question really bears out, because yes, people are going to grab, and you can say what you want. Oh, gold doesn't do nothing. No, but it is a reliable store of value. Now, again, and this is the last thing I'm going to say about the Fed. If I'm sitting in that audience around, the question I ask, of course, is, Chairman Powell, are you concerned that the dollar doesn't go down here and its deflationary impact on the global financial system? That's a fourth record, and I wait for his answer, because again, it has to bother them. This is I could tell you that some of the issue with oil is, of course, the dollar's too strong, and that's a historical correlation that does have, to me, great credibility, by the way. But
just in two things here, Ira, that I'm just looking at while we're talking, that
yep.
Apple just got the ORL daily sell stops, and SPU bonds never filled that gap this morning, that long-term gap we were looking at.
What, the 1630 on the 1631? That it's more than a gap. That's just the level that we had that in 2017. We had the quarterly breakout at the end of the September quarter of 2017 when we got a 30% move. So that area becomes always interesting to me as just, well, why does the market come back there? But we'll keep taking a look at it. So yeah, really a good point. And again, now if I said to you, and this has been mine, in the realm of the dollar, and I'm in the dollar bear camp, there is a huge discussion going on about, well, no, the dollar's going a lot higher, and you've had Raoul Powell, versus basically Hugh Henry out there going, he's in the bearish dollar camp too, that the world needs a weaker dollar, where Raoul Powell looks for the dollar to go higher, maybe up to, on the dollar index, 105 to 110. To me, yeah, it's okay, I can see it, but my response back to him is, and anybody else who's bullish the dollar, please explain to me the performance of the yen with an up stock market, and them announcing that there's no limit to the bonds, that this was out of the BOJ meeting Sunday night, Monday, that there's no limit to the bonds that they'll buy. And yet the yen is almost looking like it can put in a monthly interesting move here if it sustains itself. Now, I don't know where it's going to close by at the end of April 30th, but the fact that it's holding in here is mind-boggling. Is it holding in here because it's anticipating some coming move in the dollar. And again, if the Fed doesn't know how to weaken the dollar, because for all the money all the liquidity that they're providing, as I wrote in response to somebody, take a trillion, mimic the Swiss National Bank, and just start buying foreign assets. So buy euro currency. If the Fed were to start doing that, they would get enormous leverage and push the dollar lower, which the world needs. You know what? Buy pesos, buy whatever you can in order to push it, because the world needs a lower dollar in order to cover this phenomenal amount of dollar-denominated debt that is struggling to be kept current in being able to pay. So this needs to be done. And as long as you're out there throwing all kinds of money around, go ahead. Hell, go buy Chinese yuan. What's the difference? You may be eating all this at some point anyway. So you may as well try to get done what you want. So that would be another one of my questions to Powell at this time. Well, you know, have you been trying to weaken the dollar and it's not happening? And does that concern you? So some areas of concern, again, you're going to get a lot of, I don't know. But let me leave you with this, unless somebody has another question about, I'll take that or two, and then we'll go, and I'll give you an interesting tidbit. Anybody else?
Yep, that's it. Go ahead.
Okay. You go to Google and check out the Jenner Institute. I don't know, if you guys know who Jenner is, right? Who was very big in vaccine, and it's out of England, and
Right.
that's supposedly
Smallpox vaccine.
check it. Huh?
Jenner did the smallpox vaccine, I believe.
Yes, yeah, Jenner did the smallpox, and this is where Gates is parking his ass and doing a lot. Like he said, the Gates Foundation is now totally dedicated to the COVID, and he's been talking about vaccine. Well, this is very open, what I'm telling you. There's no secret. But the Jenner Institute ran some experiments with rhesus monkeys, I believe, in which some of the monkeys were infected with COVID, and some weren't, and some got a placebo vaccine, and others got the vaccine they're working on, and all the ones with the real vaccine survived, and the ones who didn't get the vaccine died. Okay, this is just initial, so now they're going to stage 2. But this is supposedly what Gates, he's a believer in the vaccine, but it's the Jenner Institute, and they're willing to do it without a license that you can duplicate, if this test goes even more successful. But it's just something to watch. But it's the Jenner Institute. You can go Google it. Giving you a heads up on it.
All right. Well, thanks, Ira.
As long as you may as well pay attention to real science rather than the headlines that creep out. The New York Times, I guess, had written an article about it, about Gates and the Jenner Institute. So that's where it emanates from. If they've got wind of it, maybe something's bigger there. We'll see. But thanks. And I mean, that's the way I would look at the Fed. And usually, I'm amped up to trade this when the Fed. I'm not so amped up, I got to tell you. Because I don't know what we're going to see. They're not talking about ending the program, and I know he won't give an end date because it's just not the way that they operate. But the emphasis should be on two things: that forward guidance with an exit strategy, well laid out. Give us your sense of an exit strategy, and tell me about the dollar, because I'd like to see some clarity from the Fed about the dollar.
How about the issue of buying, the non-government mortgage bonds and lower quality corporate bonds?
Yeah, we'll see what he says about that again. And they're going to ask him about, somebody will, maybe from Politico. I'm trying to second guess who's going to bring up 13.3 of the Fed Act and talk about, well, did you overstretch here? or it'll be somebody like from, it won't be Fox, but some of the conservatives who will be feted by the American Enterprise Institute. You know, so they'll be carrying that water for somebody. So it's a good point. I expect to hear something about that.
All right.
Okay.
Good stuff. Thanks.
Right. Okay.
Don't,
Thanks, guys.
great. Thank you.
Okay.